They're losing control. I'm your host, Steve Metre, and thanks for joining me today. And our lead story today, the global financial system is facing its biggest threat since the global financial crisis. And I want you to understand that this time we can't stop it. The seeds have already been planted. The machine is already in motion. Because if you think back to the global financial crisis, where did it start? It happened in the U.S. at a time when the global economy was actually in decent shape. Sure, it was slowing down, but it was okay. And then what happened as the U.S. came crumbling down, we exposed all of the cracks and the flaws in the global financial system throughout all the different countries. And next thing you know, the whole world was mired in deflation and crashing stocks and massive unemployment. Now this time, everyone says the U.S. economy is strong, it's robust, that it can be resilient. But what I want you to see is the catalyst. Where the next problem is going to take not just the U.S. down, it's going to take the rest of the world. And you're going to find out that the cracks in our system are far worse than we think. And that's why we're hanging out at the Shanghai Stock Exchange today. We've changed our shirt. We're in disguise today because we're still on the run from authorities because things in China, well, that's going to be the epicenter of the next crisis. And as you're about to see, it's getting worse. And then we're going to show you just how quick the U.S. will be right behind. And here you can see from CNBC as China's central bank steps up intervention after the yuan hits a 16-year low against the greenback. Now, it's important to understand is why is their currency losing value? It's very simple because the way a fiat currency works is through demand, not demand necessarily in terms of buyers and sellers, as I'll show you in a little bit, but just overall demand for the currency, particularly through global trade. So when there's demand and the economy is booming, you generally see currencies rise in value. So with the fact that we're seeing the yuan slip to a 16-year low against the dollar tells us that something in China is actually bad. The demand for their currency is very, very weak, and that's just a broad indication of where their economy is at and where it's headed. The People's Bank of China is set to stop this madness and keep the currency from falling. And what they've done now is for the second straight day, they set the fixing rate that was above 1,000 points stronger than Reuters' forecast and caps off 4 straight days that the midpoint rate has been almost 900 basis points stronger than forecast. So what I want you to see here is China, Beijing, is doing everything they can to stop their currency from falling. They're going all in here. But what's the problem is what I want you to understand is they're losing control because they don't have control of their currency to begin with. Now, they may be able to influence it in small moves, but broadly speaking, it's the Chinese economy that's causing the problems. Friday's move comes after the onshore yuan fell to a 16-year low against the greenback on Wednesday. And what we see is the onshore yuan is traded on the mainland and referred to as CNY, while the offshore is traded in markets like Hong Kong and Singapore is referred to as CNH. The head of economics and strategy for Asia and Oceania at Mizuho Bank wrote today that China's sputtering growth and financial risk are undermining the CNY stability. And that's just exactly the point here. What the yuan is telling us is the growth, inflation, expectations for the currency, for the country are actually going down. And that's why the currency is weakening here, because it's all of a sudden it's going to start exposing the financial risk. Now, if you think about it, if there's financial risk going on somewhere and you're holding that currency, what would you probably like to do? Well, you'd probably want to get rid of it and the assets you're holding there as well. And here you can see that Chinese state banks were then seen selling U.S. dollars to buy yuan in both onshore and offshore spot foreign exchange markets this week, and doing so with the objective to slow the yuan's depreciation, and is not really being effective here. So one thing people have been asking is, why have treasury yields kind of just gone vertical in the overnight sessions here this week? Well, you think about this. Once, of course, you're done dumping all the dollars you have in reserve. And remember, we talked about in yesterday's show, and what's China no longer reporting? Their foreign currency reserves. So you go to the banks, you tell them, look, I need you to sell dollars, buy yuan, stop that currency from falling. Well, what happens if you're short on dollars? Well, you go out and you sell your treasury securities, get dollars, and then go buy yuan. That's what we're seeing in the bond market right now, and it's really not being effective. It's working a little bit, but nowhere much as Beijing wants which is why they're losing control and about to see their whole financial system blow up. And here we can see that from Goldman, that data has showed that FX, this is the yuan, has notable outflows in July, kind of validating the view here that if you've got this stuff, you want to get rid of it. And according to Goldman, their preferred gauge of currency flows shows net outflows of around 26 billion US in July, the fastest pace of outflows since September 2022, in contrast to 6 billion in inflows in June. They saw a net buying of equities in both southbound and northbound of the Stock Connect in July, and on a net basis, small inflows through the Stock Connect channel. However, goods trade currency conversion ratio, here's key, declined and related inflows slowed in July, while services trade deficit widened. In addition, cross-border RMB transfers showed net outflows in the month, again validating that people inside the country are seeing the problem and saying, hey, you know what? I need to get my money out of here. Harky, one of our favorite ways to start a show, get your money out now, because it's looking bad in China. And with China's currency the weakest this has ever been, this from Zero Hedge, and with currency outflows accelerating sharply, one can't help but remember the panic observed after the August 15 devaluation, which not only shocked global markets, but woke Bitcoin from its long slumber as billions in Chinese savings scrambled to the safety of offshore bank accounts via one of the few open cracks in China's great monetary firewall. How long until we get a rerun? And that's kind of exactly the point here. Where we're going with this is they're absolutely losing control of the currency. China's going to be faced with having to do a devaluation. If they do that, watch those treasury bills come crumbling down. Every time China does that, what you see is just the opposite effect. Now they need to go out, instead of selling dollars, they need to start buying dollars, and that means they've also got to get those treasury securities back. And as we keep digging here, what you can see is Beijing's trying to go all in to keep things from falling apart. But what you're finding out is that all avenues around their financial system are starting to break in big ways. As China steps up efforts to stabilize markets, as confidence is slumping and routed by dismal economic data, deflation fears. So here you have it. Not only is the data bad, but people there believe there's deflation. Now you compare that to the US, nobody thinks deflation is a possibility here, except perhaps me and my friend Jeff Snyder, but nevertheless, you're seeing this factor happen there. And if you own assets in a deflationary economy, what would you like to do? Sell them now. And if you do, well, what does that mean is going to happen for future asset prices? Well, they're coming down in a big way. A weakening housing market and a crisis in the shadow lending sector, the mainland financial markets are facing the possibility of a vicious cycle of capital outflows. Foreign investors were net sellers of Chinese stocks on Friday, capping a record streak of outflows. Here again, pointing to the reality is if you've got money there or assets there, you better sell them and get them out while you still can, because prices are coming down. And if China goes under, and if it completely implodes, it's going to pull the entire global financial system down with it, because we're that interlinked. You know, again, you think back to the global financial crisis, what happened when those U.S. mortgage-backed securities started defaulting? Well, it turned out people around the world owned them. And if you don't think people around the world are invested in China, well, they are. As China's hidden financial dangers erupt with the shadow banking crisis, and one thing that shouldn't be erupting is your trading account or even your investment accounts, because if you had our CTA-Timer Pro, we'd be warning you that the U.S. stock market is likely coming down, and I want to show you the signals that have validated this. So if you're watching it, you knew about here. We've shown you before. It gave you the signal to buy in here, gave you a second signal to buy here, and along the way, it gave you some cautionary signals. But up here, we told you, look, the report is now saying, look, the trend is likely over here. Some of you said, no way this thing can be that good, that accurate. And sure enough, look what's happened now. We're seeing the tech stocks head lower. Here you can see that initial signal back on July 27th, going from a max long, starting to sell down. Look at this from today's report. And of course, we'll update you on Sunday with our chart shows. We always do. Look at this, our fast algorithm that matches those machines that trade market very, very quickly is almost at max short position and likely to pull the other ones down lower, giving you all of the warning signals you need to get out of the market or back off your positions or cash in your gains while you still have them. Because if what's coming in China, it gets to America, well, stocks are going to go down a lot. The privately owned manager for more than 1 trillion yuan, or 137 billion in its trust company affiliates, under intense scrutiny after halting payments to thousands of customers. How dare they do that? Underlying Zhongji's importance, regulators have formed a task force as they seek to prevent contagion. Now, this reminds me, of course, the banking crisis from earlier this year when the Fed stepped in and said, well, we're going to be monitoring this and we're going to be watching this. Well, the good thing is that someone is watching it. And in turn, what they do, they continue to raise rates and further invert the yield curve, oblivious to the fact of what's actually causing the problem. Well, at least here in China, they're doing the same thing. They're watching it. And they're going to watch it blow up right in their face. Behind the scenes, the firm had hired KPMG to carry out what was likely to be a protracted restructuring process as potential asset sales, here we come, threatened to weigh on the broader markets. So, you remember yesterday we talked about this. They said they approached KPMG to restructure their debt and perhaps sell some items off to raise cash. Well, what happens when you start selling things in an illiquid market, especially one where we just showed you that people are trying to get out of the market? Well, they become sellers. You don't find a whole lot of buyers, and asset prices go down a bunch. It causes further panic, and next thing you know, there's more selling, and next thing you know, outright selling around the world falls as people see deflation pulling China down and then taking the rest of the world with it. This is a problem that's not only going to intensify, it will for sure, with more funds missing payments. There's only so much they can do, this is referring to Chinese authorities, calling this a crisis of confidence. And see, it's not a crisis of confidence at all. It has absolutely nothing to do with confidence. It's a shortage of dollars. It's a crisis of a shortage of currency in terms of dollars, in terms of yuan. So you think about what we just covered here is everyone now wants out of China. They're trying to get their currency out. China's saying, hey, look, we're not going to report our foreign currency reserves anymore because if you knew how few we had, you would probably panic too. And what's happening is it's starving the system. Companies that need dollars, companies that need yuan, they can't get them. Next thing you know, delinquencies, defaults, missed payments, the whole system comes crumbling down. And that's one of the challenges as you look throughout the history, particularly in monetary policy. When you see these massive expansions of credit, what usually follows is the bust cycle, because if you don't keep fueling the credit expansion and you pull back, what happens is, again, delinquencies, defaults, and then you expose all the leverage and problems in the system, and eventually they can't hold on anymore and it blows right apart. But see, the issue here is nobody thinks right now that anything's wrong with the U.S. economy, and now let's head over to B of A to see what they think. As B of A's warning of a 5% world sinks in with yields pushing higher. So in a place like China, where clearly yields are going to go down as their economy is starting to contract, here in the U.S., everyone's buying the narrative that the Fed's got it right, that yields not only need to go higher, they're going to stay higher for a very, very long time, which is absolutely no basis in truth at all, except for the fact that it gets people to believe that rates are going a lot higher when they're not. That's prompted a rethink of what normal is in the Treasury market will look like. At Bank of America, strategists are warning investors to brace for the return of the 5% world, referring to the long bond that prevailed before the global financial crisis ushered in a long era of near zero U.S. rates, which is more likely what's going to happen is we're going to see rates more likely back to zero than we are up to 5%, because there just isn't any opportunity out there. If you think about it, if you go out and try to put money out for, say, 30 years, where are you going to find something above the current risk-free rate when you factor perhaps currency risk and investment risk that's a whole lot better deal? Well, if the long bond goes to 5%, what it tells us is the global economy is expanding, and what China's telling us, it's about to blow up. And if you take a look at BlackRock and Pacific Investment Management, they say inflation could remain stubbornly above the Fed's target. Well, that's not going to happen at all, leaving room for long-term yields to push even higher, bringing speculators in to short the bond curve or bond market even higher as they're trying to profit on this hopeful move that is unlikely to happen. because here we can show you the consumer price index in blue against one of our favorites, U.S. regular all formations gas price in red. And sure, we've seen this material move up here, but notably inflation's been lagging this time to the downside, giving us no real suggestion that anything is likely to reverse here, because as we're heading into the second half of the year, what have we already talked about in yesterday's show is that the stimulus money is running out at the end of this quarter, according to what the Fed believes. If that's the case, demand's coming down, as well as demand for energy, and that means, of course, inflation follows. It's not only that, but we talked about the imports of goods and services being a great leader of inflation, along with the fact that Chinese import prices factor in here as well. But you can see imports heading down, showing us the demand in the U.S. getting lower and weaker, particularly again as we run out of stimulus money. And not only that, but face the resumption of student loan payments here in October or September. And if we look at consumer price index against federal government tax receipts, well, this is a wonderful lead of inflation, because you see tax receipts heading down, and every time it does with a nice lead, inflation comes with it. Here we can see federal tax receipts are contracting, suggesting the economy is indeed shrinking. That brings inflation down, because obviously if the Fed's collecting less money, that means there's just less money out in the economy. And of course, if there's less money, you can't sustainably maintain inflation or demand in any way, shape, or form, suggesting that B of A strategists have got this call all wrong. They might be shorting the bond market hoping to profit, but again, the likely path for yield is actually lower and not higher. The market is coming more to the view that there's going to be long-term inflation pressures despite recent progress. Macro uncertainty is going to remain the story for the next few years, and that requires greater compensation to own long-dated bonds. There's not going to be uncertainty. The only uncertainty is going to happen as China continues to slow down and blow apart. It's going to yank the rest of the world down, including the U.S. And you want to talk about our risk? How about the U.S. banking system, the regional banking system? Well, we've got some updates on that coming too. But many now expect a soft landing, which is more likely a fat chance than anything that would leave inflation the dominant risk. That was underscored this week by the release of the Federal Open Market Committee's meeting with minutes from July, when officials expressed concern that more rate hikes may still be needed. They also indicated the Fed may keep paring its bond holdings, which doesn't actually make any difference, even when they decide to ease rates to make policy less restrictive, threatening to keep another drag on the bond market, as people somehow believe, even though they're not actually selling hardly any 30-year bonds, because they're only selling the maturing issues, so it wouldn't make any sense. But again, everyone believes that because the Fed's selling and the government's issuing, that suddenly magically that means rates go up, even though at around $30 trillion in debt, if that was true, shouldn't interest rates be double digit by now? But it's not the case at all, because it's not how the system works. As we point to the risk in the U.S., if there is contagion risk spreading out of China, well, it's a regional banking system, because look at this. Banks' usage of emergency Fed funds hits a new record high. So things here aren't actually getting better. Maybe people's perception of the economy is improving, or maybe they're more hopeful. But the banking system is getting worse, not just a little bit, week after week after week, suggesting all it's going to take is a little bit of a shock, a little bit of a nudge, and off the cliff, you're going to see a whole slew of banks fail. And here we can see the Bank Term Funding Program, usage on it has gone up again for another week. But yet here we can see Americans keep spending, but for how long? Well, big retailers doubt it's going to last a whole lot longer, and they're right. But there were signs of weakness for the retailers, and executives were at pains to share their worries for the rest of the year. Consumers have yet to regain their appetite for big-ticket items and non-essentials, and that dragged down sales at Target and Home Depot despite their better-than-expected profits. So if you think about discretionary spending, what they're telling you is discretionary spending is getting pared back here. People aren't just out throwing money around like they used to. In addition, executives warn that new pressures such as rising interest rates and student loan repayments could take the wind out of consumer sales during the second half, which is true. Jobs, wages, and pockets of disinflation. What? Disinflation are helping our customers, according to Walmart. But rising energy prices, yes. Resuming student loan repayments, they got that right. Higher borrowing costs, you got it. Here's the big one. Tightening lending standards. Now, can you imagine this? CEO of Walmart actually getting this and nailing it right, and a drawdown in in excess savings means that household budgets are still under pressure, and he is absolutely right. Here you can see the consumer price index. We're switching it to red because I have it saved in my system with the net percentage of domestic banks for commercial industrial loans to firms of all sizes. We're seeing how they tighten standards, and sure enough, when you tighten standards, eventually you see inflation come down, and the simple reason why is when people can't access credit. When consumers cannot borrow anymore, well, demand goes down, and next thing you know, inflation falls with it, and that's why the U.S., see, we can't stop this now. We're in too deep. Problem is, China's going first, and we're going to be right behind them. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.